the red-hot IPOs just keep coming. I thought they might peter out after the Uber fiasco, but we keep getting new deals, and some of them are even good. Just last week, we got an incredible one. I should have known this because my youngest told me about it. It's called Revolve Group, RVLV, which is an online fashion play that is shaking up the entire retail industry. Revolve came public at $18 a share, then opened at $25, and finished its first day of trading at $34. That's almost double in the last 24 hours. Woo, in less than 24 hours. I got to tell you something. When I see that just keep going up, tell me big institutional buying. And it just keeps roaring. Today, Revolve tacked on another buck, 3%, climbing to $36 and change. But before we write this move off as yet another sign of a somewhat frothy market, it's worth getting our heads around what Revolve actually does. Because maybe there's something real here. Don't forget, Beyond Meat really works. It just shot out of the gate. But that was because it was a fabulous story, and the deal was very underpriced. I was gun-shy on that one. I told you to ring the register way too soon. And now, well, it's just too late. I don't want to make the same mistake with Revolve. So let's play Know Your IPO. The real interesting thing about Revolve Group is that it's making a killing in an environment where most retailers are getting killed. Other than Walmart, Costco, Target, throw in TJX, it wasn't that great, of course, but throw in TJX. The group is having a very hard time, especially department stores that are in high fashion businesses. Yet Revolve sells the same stuff they do, and they're absolutely crushing the department stores. In fact, you might say they've become the retailer of choice for millennials who can afford it. All right, how does Revolve work? Well, it's an online store. Actually, 3 stores, the high-end Revolve, the even higher-end Forward, and the lower price point, the Super Down. Now, the company was founded in 2003 with the idea that traditional retail was either too mass or too niche. They wanted to create a digital platform that would be targeted more targeted than department stores, but with a broader selection than specialty stores. Then Revolve built their own technology platform with automated inventory management, pricing, and even trend forecasting algorithms. They take data from millions of customer interactions and use it to predict how fashions are going to change. That enables Revolve to pick the right merchandise. Don't you wonder if they use the Tableau? Right? I mean, this is what you're talking about. Taking that data and making some nice charts about it tells you what to do. The fashion business has always been more of an art than science, right? But Revolve is trying to change that. Yes, they'll launch 1,000 new styles every single week in small volumes. And then they double down on whatever works. I think this is a brilliant idea, and we know it's working. How do we know that? If you're a department store, inventory management is the bane of your existence. When you bet on the wrong merchandise and it doesn't sell, you end up marking it down until the customers are willing to take it off your hands. That's right. Roughly last year, 79% of Revolve sales were at full price. That means no promotion. That's pretty amazing. That's up from 75, which was also good in 2017. Yes, they're doing very little discounting at Revolve because they know what their customers want. And they're not just selling other people's clothing. Revolve has 21 company-owned brands. These are private label brands, but the company markets them as independent because that gets more traction with consumers. In the past year, Revolve's brands made up 8 of the top 10 best sellers, accounting for nearly a third of the company's total sales. Obviously, it's more profitable to sell your own merchandise than to sell someone else's. And this is, guys, this is not cheap stuff. The average order was $279. It's not bad. That's how Revolve could have a gross margin that's that money that they make after the cost of goods sold of 51%, which is spectacular for a retailer. You'd think they were in the jewelry business, for heaven's sake, not the apparel business. At the same time, these guys are adept at using social media to sell to millennials. Yeah, they got 2,000 they got thousands of influencers, the people who say good things, and brand partners helping to move merchandise. That's how the company gets 56% of its traffic from free or low-cost sources. Revolve's now getting 9.8 million unique visitors per month, but management believes the company still has an enormous amount of room to be able to grow. They've only got 3% market share in their demographic right now. That is ridiculous. This has got so much runway. I really like this story, but how about let's deal with the numbers for a second. In the first quarter, Revolve had 21.2% revenue growth, driven by nearly 40% increase in the number of active customers. Not shabby. Total orders were up 39%. Cash flow from operations grew by 31%. And the company's profitable. You heard me, profitable. In fact, they've been consistently turning a profit for years now. This is not your typical red-hot IPO that's all about revenue growth with no concern for earnings. Revolve's pristine balance sheet. I love it. The only negative is that their margins took a little hit in the first quarter. But that's because they rolled out their new lower price concept, super down. When you look at those numbers, it's easy to see why the stock exploded higher right out of the gate. And, even Andrew Lepp, that noted short seller, Citron, he's notoriously skeptical, but not about this. He actually came out with a positive piece on Revolve. Hey, that's good endorsement when a negative guy does that. So where do I come out in this one? As a company, I think Revolve Group is fantastic. Lots of startups like to tell you that they've discovered the business model of the future, but in this case, there's strong evidence that Revolve has figured out the right formula for an online department store. We know it'll work because it's already working. The numbers are that good. Plus, I think that the timing of this deal couldn't be better. This IPO cycle we've seen, company after company come public too late in the lifespan. That was the problem with Lyft and with Uber. Their growth had already peaked years ago. Well, in the case of Uber, you could say last year. But, you'll come back public with rapid revenue growth, but no profits. And then there's a painful period where your growth slows and your profitability doesn't pick up enough to offset the revenue softness. However, Revolve has already made it through that awkward phase, and the company is still young enough to keep delivering excellent numbers. In short, Revolve, the company, has a lot going for it, but Revolve, the stock? All right, that's more of an open question. At these levels, the darn thing sells for 90 times last year's earnings estimates, about 5.5 times sales. A little better, but it's expensive. Of course, investors don't seem to care about valuation when it comes to red-hot IPOs right now, but it's still worth keeping in mind. Granted, the company more than quintupled its earnings last year. It still might end up looking much more cheaper in retrospect. That said, I just can't bring myself to recommend a stock that's a little more than doubled in the past week. It feels too much to me like chasing. I like Revlon. I like Revolve. But I think you need to wait for a better entry point if you want to buy it. Here's the bottom line. In a world where department stores keep losing vast amounts of business, you got to wonder where that business is going. At least in some of its cases, it's going to end up at Revolve Group, which is why I think you should put this stock on your shopping list and wait for a pullback, which I think we can get. It gets to the low 30s. You know what? Just go buy some. If that never happens, well, you know what? You got to say you missed it. Marvin in New York. Marvin.
How you doing, Mr. Cramer?
I am good, Marvin. How are you?
The question I have is, Macy's. Macy's has $19 billion to $21 billion worth of real estate. The one piece of property in Manhattan alone is worth $8 billion. Macy's market cap is $6.8 billion. So that one piece of property could buy all the stock. The net income on Macy's is $1.1 billion. The EPS, earning per share, is $3.58.
Right.
With a PE of 20,
right.
The stock should be 70 on it. I'm surprised some hedge fund, Carl Icahn, somebody will come in there and buy a lot of stock and force their hand.
Well, Starboard did a good analysis, was okay analysis of the real estate, and they got nowhere near those numbers. I think those numbers are wild high. Also, the growth is really suspect. That's why it sells for about 7 times earnings. I'm not buying into this one. I am very sorry. I like the company very much, but not as a real estate play, more as a get paid to wait before it catches on fire and Jeff Gannett gets the job right. All right, some retail businesses ending up at Revolve Group. Wait for a pullback, though, before you pull the trigger. Much more Mad Money ahead. With roughly 50 million residential properties and $10 trillion in amassed debt, the American mortgage market is the largest source of consumer lending on earth. Tonight, I'm talking to the #1 retail mortgage lender to find out what's happening. Don't miss my exclusive with Quicken Loans. Then I'm telling you why Eli Lilly and Johnson & Johnson are emblematic of the overall market. And the way your calls rapid fire, tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.